Hey guys, this video will focus on the weaknesses of the budget in achieving equitable distribution of income. We've talked about the budget and how it has limitations when achieving domestic economic stability as well as external stability. So we're going to focus now on how the budget can have limitations when trying to achieve or distribute income equitably. So we're going to split this lecture into two parts. So in this first part we'll look at how taxation has its limitations and how transfer benefits, either direct or indirect, have their limitations as well. Okay, so let's start off with the limitations of direct tax. So we know direct taxation includes 1, income tax, which is said to be progressive. 2, company tax. And they're the major sources of direct taxation as revenue for the government. So income tax is progressive, company tax is proportional. So it is also called a flat tax. So we're going to look at the limitations of these direct taxes as implemented by the government. Now there are 2 major limitations to direct taxation. So one of these reasons is that over time the steepness of marginal tax rates have decreased. So what this means is that those on higher incomes have now experienced a decrease in the marginal tax rate paid on the top bracket. So, and a very pertinent example of this is that in the 1960s, the top bracket paid around 75 cents for every dollar in tax. So if you earned the most in the country, then you would have had to pay 75 cents for every dollar in the top tax bracket. So now we look at the 2000s, and the top bracket only has to pay 45 cents for every dollar. So obviously, because those on higher incomes pay a lower rate of tax now that they did before, we can see that they would therefore have a higher disposable income or greater disposable income than before, and so would greatly increase inequity. So that's the first reason why marginal tax rates have decreased. So not of why there are limitations to direct tax, because of these decreases in marginal tax rates, I should say. And secondly, again, we're going to look at company tax rates have decreased. And this is another similar concept to how personal income marginal tax rates have also decreased. So company tax rates have decreased from 49%, this was only 20 years ago in 1986, to around 36% in 1995, to 30% in 2002, and now there's even proposed that the company tax rate is going to be 29% starting 2012. So we can see that there has been a trend in recent years of a decline in company tax rates, and so what consequence that has on equity is that those companies who earn higher profits pay lower rates of taxation, and therefore the government has a decreased revenue source, and so they would be able to transfer less in transfer payments to those who are genuinely needy for transfer payments. So that's the first major limitation to the budget, is that direct taxation rates have decreased significantly over time. Now, the second reason of why there are limitations to the tax rate or to direct tax is that we have a lot of untaxed income. So this is what is known as the black market. So those transactions not actually recorded in the market are not taxed because the government can't tax for many reasons. So those who are self-employed or in various trades that require cash payments rather than transferred payments online, they could declare a lower income. Even though they earn $100,000 a year, they could declare $50,000 and therefore pay less tax. So this is very hard for the government to monitor, and even though it's illegal, it's called tax laundering, but many people still do it, and that's another limitation of the tax because it is very hard to monitor. So often it is those rich who actually stand to gain most by using these practices because of this progressive income tax rates. So those who are richer would actually declare less tax because of this black market. So that's the limitation of taxation, or direct taxation, is that some people may not declare taxation to avoid paying income tax. Okay, so that's the first limitation. I'm just going to leave this up here. Limitations of direct tax. Now we're going to move on to the second one, is this limitation or weaknesses in direct welfare. Okay, let's just rub all this out. Okay, so the second limitation is weaknesses of direct welfare benefits. So over time, the government has tried to increase our aggregate supply side conditions, right? Conditions. And so what they have to do is they have this trade-off between equity and efficiency. We've gone through this trade-off in our lecture on equity and efficiency, so if you want to touch up on that, just simply move on to the lecture on equity and efficiency. But what this means is they have tightened welfare. So they have decreased their welfare payments, or made means and assets tests harder, so that there are fewer people who qualify for work transfer payments or government income. And so this encourages people to enter the workforce, encourages people to develop skills, and therefore that is, although beneficial for our aggregate supply, it has made it tougher for those who genuinely need the income. Secondly, there's another problem, is that some welfare benefits are so low that, low welfare benefits, they're so low that people living off these welfare benefits are in fact living or forced to live below the poverty line. And this is very hard for the government because they need to make this balance between equity and efficiency so that they don't overpay or over generously pay welfare benefits, so that it discourages people from entering the workforce and live off transfer payments, which is also known as the welfare trap. So they want to avoid, just going to note here, the welfare trap versus efficiency. That's a very, very important trade-off the government has to weigh up. And thirdly, in this part one of these lectures, is that indirect taxes are regressive. Now, we talked about regressive taxation. Indirect taxes. Indirect taxes are regressive. There we go. Bit tricky to write indirect taxes, but okay. Indirect taxes are regressive, and that's a third problem facing budgetary policy, because although indirect taxes contribute to around 27% of budget revenue, they are regressive in the sense that as your income increases, you pay a lower proportion of tax. So what this actually means statistically wise is that those poorest 20% of the population, they pay around 20.5% of their income in regressive taxation, whereas the rich, or the richest 20%, 20% read it out 20. So the richest 20%, they don't pay 20.5% of their income in taxation. They pay a mere, well, a little 8.9% of their income in taxation. So although these taxes are essential for the government, for government revenue, to provide goods and services in the form of indirect benefits to the community, they are aggressive, and those poorer who actually need these benefits actually pay for those, pay for the large proportion of these tax or these benefits from tax. And so what the argument here is that necessities should not be taxed, because those who are on lower incomes require these necessities to survive, and in order to make a more equitable distribution of income, these necessities should not be taxed, whereas luxury items should be taxed more frequently, so that they target the rich, so that the tax burden is actually borne on the rich rather than the poor. And although the government has aimed to increase taxation of luxury items, such as the luxury car tax, for example, that is the regressive taxation in GST and excise duty are inherently built into the budget, and therefore represent weaknesses of the budget in achieving this equitable distribution of income. So we're going to move on in part 2. We're going to talk about the other 4 limitations of the budget to achieving an equitable distribution of income.